Hello and welcome to the first weekly review of the year. Wishing everybody happy new year. Hopefully you had a healthy and wealthy slide into 2022. And going forward, wishing you the very best. Kicking off this week's analysis by having a look at CFTC data covered by Scotiabank. As we can see, very interestingly, even though GBUSD probably rallied better part of 200-300 pips off the lows, net positioning is increasingly getting heavier, which comes down to the question is, what is market thinking? Why speculators continuously adding to short position on GBP while the Bank of England actually lifted rates and is continuing to do that? That should ideally be positive, but I think there's a couple of other things in the background brewing for the UK economy. A bit of a slowing GDP and some other headwinds. That's why they believe GBP/USD should come down in the long term. And I believe that too, but in the short term, I think they're all going to see a pain trade, as I like to say. On the Euro side, we didn't see a lot of positioning readjustment, and it's more or less stood the same. I like to have a look at real yields, US real yields. In the last few videos, I covered what the relationship between gold and US real yields is, and recently we've seen our US real yields dropped again. That's why you see gold rallying, and as long as this continues to drop, you will find that gold will rally based on the seasonality we have in January. I've ran the data over the past 10 years. 8 out of the 10 we saw quite bullish reaction from gold in January, so I'm expecting more or less the same. But overall, in the long term, I made it very clear because rates are rising across the board on all central banks, holding gold is not as attractive. That means long term gold should be lower, but don't stand in the way probably in January as it starts rallying again. Another thing I like to point out was the yen pairs that saw a really strong surge end of the year. The blue chart is the inflation expectation expressed via the bond market. Has recently been rallying, and that took the yen pairs with it. So we overlaid that with ADJPY. But if you look at any other yen pairs, you must have noticed the strong surge. For my analysis, the inflation expectation chart should top out at 3. So here we saw a poke through in middle November, but I believe that's still sort of the ceiling. It'll be very interesting to see if this actually starts climbing above it, and then yen pairs will be really strong. But based on what I know now and the way the things are evolving, under 3 we're quite safe, and that's why I think a lot of the yen pairs will top out very soon and start coming back down quite hard actually. So that's kind of the basics. I wanted to cover what happened over the last week as we didn't have a video, and also what to expect. I like to have a look at the upcoming week. The only data point that really interests me next week is probably NFP, and unless you've been living under a rock, you will have noticed that coronavirus is spreading quite aggressively again. And for my analysis, it shows that a lot of that is causing people to shy away from going to jobs. That also could affect the job market, or the job market data coming out on Friday quite strongly. And as market is quite hawkish on the Fed reaction and the interest rates, any bad data could really harm USD a lot here. So I'm looking to front run this whole idea by buying EURUSD next week towards closer as we move to Friday. I believe the data will reflect that the rise in the lift in the cases, coronavirus cases. That's what I wanted to say. And I believe that will be negative for USD. We saw a pattern here where it kind of broke out last week from an inside daily bar. So when it breaks the high, usually bullish, we can see some bullish traction. That's not the only reason why I want to be long EURUSD. So one of the reasons where I think data might be a little bit bad for the US in the short term. Another reason is my yield spread chart is telling me that the premium US against the euro is a little bit coming down, and that also means that EURUSD should be trading higher. So this is the yield spread chart between bond and bonds. Usually EURUSD tends to follow that really closely. So if I were to compare that chart with EURUSD, you can see more or less the trend setting is really to a different magnitude, as one is obviously the bond market, the other is FX, but to a great degree the major turning points are in line. That's why I'm expecting EURUSD to catch up with the yields as they start to contract a little bit more recently. I like to see EURUSD about 115 would make sense. Again, long term, I'm really bearish on EURUSD as the Fed is more hawkish than the ECB can ever be, and I believe that the yield differential will widen again down the line. As we go into next week, it feels like it's a good idea to buy EURUSD because of the fact that possibly the NFP print will be quite negative and market will be front running that. So that's something I'll be looking into. There's loads of other things obviously moving in the market as we are turning the page in January. I'll be discussing them further down the line. Specifically, some really interesting things happening with the oil market that could have implication towards the rest of the year, as we're looking at inflation as well. But in the very near term, I'm quite keen to see if I can see a bit more upside in EURUSD as we move towards the end of the week. Thank you all, and I'll catch you all next week again.